Welcome to Tradiers, the Trader's Edge. I am Jim Urio. That's Bob Iacchino, and I know you people have been sitting in front of the computer for hours waiting for the best part of the week, the live event. Thank you for joining us. Bobby, have you had your caffeine yet or no?
Yeah, I actually had so many espressos today, my stomach was starting to bother me, so I took a caffeine pill, which is really healthy.
That's fantastic.
Yeah.
What's a caffeine pill? I mean, I haven't seen those since college. They're still around?
They're still there. No dose. Another one is called like Jet something or other. It's like 300 milligrams of caffeine without the coffee ingestion.
I remember in college, someone tried to crunch up those no-dos and snort them like cocaine. I don't remember what the end of it was, but it seemed like things were going south. So I think I hightailed it out of there, which I was always good at. Yeah.
God, just have cocaine. What's the big deal?
Exactly. So anyway, this has been an enormous week in markets. Okay. The former and perhaps future President Trump dodged a bullet on Saturday, literally. And it kind of seemed like it solidified to a certain extent his win. What's the biggest trade that's going to come out of that?
I think equities. I got to be honest. I think equities. Now that may be short-lived because we've seen all the different stories about how Trump is inflationary. And you and I have been talking about this over the last few days with different people and with each other and on different shows about how inflationary Trump may be versus Joe Biden. We don't know. Somebody told me that you have to pay attention to Trump. What was the wording? Take him seriously, but not literally.
Not literally, right.
Yeah. And I heard somebody today, I couldn't tell you who, that said that tariffs is a stick that brings people to the table. Those tariffs aren't going to go into effect. So I don't know how true any of that is. All I know is that last presidency, Trump pushed to deregulate everything, to drill for everything. That's deflationary on energy prices, as well as pushing for lower rates, which I guess that would be inflationary at this point. Yeah. So both of them are spenders. So I don't really know what to think. I just think that there's, at least right now, there's clarity, man. But we got 3 months till the election.
Oh, God. Anything could happen, and anything will happen. We're going to be teaching about these next 3 months in history class for the next 500 years. I think crazy shit's going to happen. Anyway, you guys know the drill. I say this every time. You may listen to Bobby and I think we're full of crap, and sometimes we think we're full of crap. So we even agree with you sometimes on that. However, one thing you can't ignore is that we get fabulous guests. And right now, I'm excited, particularly because this one, all I have to do is ask one question, and then I can just sit and drink my tea the rest of the time because she's so smart. We want to hear everything she has to say. We're bringing in now Stephanie Pomboy of Macro Mavens and Brilliant Genius. I tend to give people like effusive compliments on intellect because deep down I know that generally I think I'm the smartest person in the world, and I try to deflect that. But you're actually someone who I really mean it when I say it. So thank you.
Well, thank you. Well, I'm the opposite. I feel like I'm the dumbest person in the room always. So I guess
you got brilliant and genius.
Brilliant and
genius in one introduction. That's pretty impressive.
A lot of compliments. So it's so good to have you. And I know I do want to talk about some bullshit because I want to know what's your attraction to Bulldogs. But we got a lot of market stuff. But let's go hit the Bulldogs thing first. Is that okay?
Yeah, absolutely. I mean, I think you would understand why Bulldogs if you watched the RNC last night. I mean, I think that Bulldog got as loud an applause as pretty much anyone else who spoke, and deservedly so.
I agree. But here's my question, and I don't mean to piss you off and have you hang up, but I like Bulldogs. Do you like Bulldogs because they're so ugly that they're cute?
Oh, I think they're beautiful.
Okay, then I retract the question. I retract the question completely because they're not so ugly. Obviously, they're beautiful animals.
I mean, honestly, the reason why I love there are a lot of reasons to love a bulldog, but I think actually the West Virginia governor summed it up, my feelings 100%. And that is when I walk down the sidewalk with her and someone's coming toward us, they just immediately start either laughing or smiling because it's just such a ridiculous looking creature. And it just makes you laugh and smile and brings joy to everyone. So
and they're a very kind and loving breed too, which is very cool.
Yeah.
Okay, let's move on to markets because a wild week. So I think the most interesting part, and you correct me if I'm wrong, but I want to break it down, is the wild move higher in the Russell compared to the shellacking curb stomping that the Mag 7 or the Magnificent, whatever, how many the number is. Is this something? So here's what I guess what my question is. I will argue that, yes, the environment for those things have changed a little bit if Trump is going to be president. But the question becomes, how deep are the positions in those things that could accelerate the second leg? Is there a huge unwind that's got to come in this, you think?
Well, you guys are much better in terms of the actual market internals and what's going on there. I basically sit here and look at the macroeconomic data and then try to decide how much of what I view as the economic path that we're going on is priced into the markets. And for a long time, I felt like the policy coming out of this current administration has been so bad. I couldn't understand why the markets kept going up and up, except that they anticipated things were so bad that the Fed was going to have to come in and cut rates dramatically. And that obviously was sort of the thing that was driving the market, was just this pivot hope. And even as that pivot got pushed farther and farther out in timing and in magnitude, the market still kind of hung everything on it. And that's why I believe you saw that increasingly narrow participation of stocks. You just kept building on this hope. And the longer it took for the actual rate cuts to be delivered, the less helpful it was for like those Russell 2000 companies that really need actual lower rates to subsist. And a lot of those companies, for example, a lot of the smallest companies don't have access to the capital markets, which have been generally very accommodating. They're actually trying to go out there and get bank loans and whatnot, that is much more higher cost for them. So I understood, I guess, why the dynamics were like that. I just didn't think it was sustainable. So it's welcome for me to see this broadening out of the rally. And I do think that if it's Trump 2.0, the economic outlook has changed dramatically. I've been saying that we were headed into a recession, and a lot of the indicators that I've been looking at have already slumped to recessionary levels, are worse than that even. And so now I'm sort of puzzling with, well, what's my new economic outlook? If Trump's going to win and he's going to do all the things you guys were talking about in the open, drill baby drill and massive deregulation, just like it did in 2016, then a lot of this hope is founded, albeit for different reason. Now it's not hope that the Fed's going to cut rates. It's hope that the economy is actually going to have a tailwind rather than these blustery regulatory and tax headwinds. So, now what I'm wrestling with is, okay, that's great. So the economic outlook, let's say, has arguably improved, but we've already discounted so much wonderful things in this market. Valuations are so stretched. How much further can we go? So that's really more a question for you guys, but I'd be, bullish on the economic outlook and probably cautious about what it means for the markets. And if I could take 30 more seconds, even though I've rambled endlessly already.
No, not at all.
I was just looking back at Reagan. When Reagan was running in 79 against Carter, and everyone was so, beside themselves with the Carter policies and the dismal state of the economy and inflation and blah, blah, blah. It was a fairly miserable time for the country. And when it became clear that, there's a chance we might actually see Reagan win, from March of 1980 through election day of 1980, the S&P was up 41%.
Whoa.
Huge. It promptly peaked on like November 18th and went down 27%. And it took 2 years to retain those November election day highs. So, maybe we're seeing a repeat of that today, where the markets are getting super excited, discounting this very welcome shift in policy that might be coming. But what happens, it's that kind of classic buy on the rumor, sell on the news type of thing. Anyway, that would be my last comment on it.
There's so much I want to ask you, and I'm trying to resist the urge to make it all one long question. So let me just start with this. First of all, Reagan was 69 when he was elected. And I think at least Jim and I are old enough to remember that people were concerned with his age. And now we've got two guys that are a minimum of 12 years older or more, depending on which candidate that's running right now. So, I mean, he's positively juvenile compared to them. The question I have for you, though, is on the inflation front. So to me, the rate cuts are a be careful what you wish for kind of scenario, right? If it's an adjustment to monetary policy, fine. If it's a rate cut cycle, it's an issue.
Yeah.
What do you think a Trump presidency would mean for either a rate cut cycle or inflation more generally? Do you think he's inflationary, regardless of whether he's more or less inflationary than Biden?
Well, I think that first off, we know what it looks like to live under the world of Trump. So this whole panic about tariffs being inflationary, well, they weren't when he did it the last time, because tariffs are only inflationary if you can pass on those higher costs, if consumers are willing to gobble those up. The consumer in this country has absorbed so much in the way of higher prices already, and they're clearly now, as evidenced by all of the commentary from consumer-facing companies during earnings season, starting to say, this is it. We just can't take it anymore. We've hit our max. They're cutting back on discretionary spending. I follow very closely the restaurant industry because that was kind of the last shoe to drop, and it is dropping. So I think the question is really, if he actually goes through with these tariffs and it's not just, a negotiating tactic, the assumption that those tariffs are going to get passed right along to consumers, I think, is one that deserves to be questioned pretty seriously. As relates to inflation more broadly, I think the critical thing is this energy policy. We saw almost immediately when Biden first day in office, started basically clamping down on domestic energy production and relying on our frenemies or enemies around the world to provide us with the fossil fuels we needed, because God forbid we, extract any of our own resources. That was what drove inflation up to 9%. I mean, sure, there were supply chain issues too, but really that was the match that lit the fire. And I think that once you can get energy prices under control, it feeds through everything. I mean, I don't need to tell you guys this, it's not just filling up your gas tank, it's getting the food to the grocery store and creating the plastic bag that the cereal that you're buying goes into. And, it's in everything. So from that standpoint, there's a huge disinflationary potential with the Trump administration. And the other thing I would say is relates, Bob, to your question broadly about monetary policy is, in theory, right now, the Fed doesn't have a whole lot of rationale to cut interest rates because, as everyone in the market seems to believe, the economy is, it's a little slowing, but no one thinks there's really a chance of a recession. Inflation is still above the Fed's target, and the unemployment rate is edged up to 4.1%. It's not exactly what you would call, intensely high. So the argument for the Fed to be cutting rates is pretty thin if you look at it from that standpoint. So if you're now going to layer on massively pro-business economic policy that's going to get growth accelerating again, really, what's the case for the Fed to be cutting rates in that environment? So I think that's another problem. And I start to think about, are we talking about an environment where rates therefore settle at a higher level? And I think you may be starting to see that kind of thought process playing out in the 2-year and the longer dated Fed funds futures, which have started to edge up actually in yield in the last 2 days. So maybe there's a sense that if you have a stronger economy, you're not going to get as much Fed easing, but on the upside, you'll get growth in earnings, so that'll be supportive of the market insteed of liquidity.
Wait, we're going to buy stocks just for the right reasons? Finally, it's been like,
that's the thing.
25 years.
Wow. People criticize me for being a perma bear, and I'm like, I'm sorry, but I don't see a cycle of lather, rinse, repeat where all we do is layer more cheap debt on top of debt on top of debt, right, and have no real fundamental growth underneath it. I mean, I didn't think that was a very compelling reason to buy stocks, but now I'm starting to think, we could see a real shift in the setup and focus more on quality economic policy and keep the Fed out of the picture as much as possible, because the Fed, has a perfect track record of doing much more damage than good.
Well said, by the way. Bobby, this is going to be a quick question for you because you mentioned energy a second ago and drill, baby.
Yeah.
Drill. So is the 4 years that we've just experienced where, they limited new drilling, they, and all these wells are been ramped up to max productivity because there's no new wells coming in. Is that going to leave a mark if we immediately flip policy, encourage, and comment on also the sell the oil, buy the integrateds, which caught me so off guard? Because oil should go lower in a Trump presidency. Mm-hmm. And also he's going to be a lot more kind to the Exxons and the Conocos around the world. And those could rally at the same time crude's going lower. Do you have any quick thoughts on that?
So politically, here's the problem with it. President Obama liked to claim that the U.S. reached record number of barrels production under his administration. And President Biden does the same thing. But in the research that I've done, you're talking 18 months to 3 years, not counting leases. Okay, so not counting exploration and getting the leases before a drill starts to produce. So when the administration before you is drill, baby, drill, the administration after is generally the one that
gets the credit,
is in charge when the oil starts coming out of the ground.
Yeah.
Right. So, and it's going to be the same case here. Obviously, if President Trump does win, which it looks like that, he's not going to be the one stewarding the excess production that comes from his decision making. Right. Because again, you got to start the clock, and you're probably, unless there is a red wave, you're probably not starting the clock till after about the first 60 to 100 days. Mm-hmm. So you've already got the next president who's going to be saying, look what I did the second that I got in office. That was my
right.
thought.
So who will that be? Sarah
anyway,
Sanders Huckabee or Vivek, the next president after Trump? Yeah.
I don't know. I think it's going to be Kanye West if I have my way. But no, it works out that way. But, luckily at this point, you can make the case if you want to take credit. You just have to start making the case while you're doing things and explain it to the American people saying, hey, we've been at record production because of what I did. It rings hollow because so many politicians have always said, well, the previous administration left me this. And then the second I took office, I turned this ocean liner around like it was a speedboat in this. Yeah. Whatever happened the day they took office was to their credit. And whatever happened 3 years later was what the previous administration left. And it's always been that way.
It's always been that way. Just Steph, what do you think about the oil trade from is crude oil a long, even if Trump's going to win? No, right?
Well, I have been long. I mean, I've really liked the oil trade because of the ridiculous Biden policies.
Right.
So now I'm kind of wondering, what do I do with that? But I look at the screen today and you still have oil just barely below $83 a barrel. So if
technically it looks good.
I'm sorry.
Technically it looks good still.
Yeah. I mean, that's the thing is, if drill baby drill is what everyone's discounting now, it's not really having much of an impact on the price as yet. And I mean, it stands to reason because there's still 4 months to November, plus another 2 months to get to inauguration day. And then, like you're saying, Bob, a lot of time before all this stuff actually goes through. Against a backdrop of massive geopolitical unrest. And now you've got a period where if the rest of the world, if people like, China and Iran and Russia think the clock is ticking and they only have 4 months to do whatever mayhem and destruction they want to do, I don't know that I want to be short oil in that period.
Jimmy, this is sort of for you, but Steph, you as well. Do you guys think that, again, we're talking about the election a lot, and I don't really want to focus on it, but do you think that a Trump presidency, we're going to have a real-time experiment going on, right? Trump says Putin would not have invaded if I was in office. He's too scared of me. Hamas, Israel wouldn't be going on if I was in office. Russia, Ukraine wouldn't be going on. Now he's theoretically going to take office. What if it just stops after that? Like, do you think there's anything to that, or have the horses left the barn, for lack of a better phrase?
Can I just interject real quick with my answer, Steph? I think there is
No, it was to you.
Yeah, I know, but you're the guest. I just like
No.
that permission, and
To
you're
both of you.
brilliant and genius. But I think there is a little something to what Trump's saying. I think it's said with the Trump normal bluster, hyperbole, over dramatizing it. But I do think there is actually something to it. I think that whatever he was doing regarding foreign policies, it seemed like our enemies and frenemies all towed the line. Maybe they thought he was crazy. Remember that whole thing at the beginning? Trump's nuts, and he launched the missiles at an empty base in Syria to prove how nuts he was. Maybe that shit worked. So I don't know. I do think. Well, I think that Ukraine, whether or not it's a valid, our defense of them is valid, is notwithstanding about what I'm about to say. It has morphed into a bit of a money laundering operation. The question just becomes, what percentage is it? Is it 20% that's being skimmed, or is it 60% that's going to defense companies who are then kicking it back to Democrats and campaign donations? Sorry, if you think I'm a weird conspiracy theorist, sorry about that. I am. But I do think that there might be something to Trump that he's a little better at foreign policy. What do you think, Steph?
Well, I think it really comes down to money. I mean, it takes money to wage wars and take over territories and do all of these things. And that money comes for a lot of these countries, Russia and Iran in particular, from oil. So having the price of oil double because of our green energy policies and our refusal to produce at home, I think immediately enriched and emboldened these other countries to start doing these things. And the fact that we had an administration that seemed, shall we say, incapable of seriously addressing the threats or just not taking them seriously at all was just another impetus for them to do so. But I think it really comes down to money at the end of the day. I mean, Iran was basically bankrupt until Biden took over.
Yeah. So just for people watching too, and some of you might be too young to remember this too, one of the ways we broke up the whole Iron Curtain was driving oil prices down to $9 a barrel and completely bankrupting Russia, and they didn't have money to finance it anymore. That's fair to characterize it that way, right?
Yeah, absolutely.
Okay, can we pivot to gold? Gold has been flying, and this is a really interesting trade too, by the way. Gold's been flying very nicely while silver and copper has lagged it the last couple of days. Again, it kind of threw me a curveball because they normally move in at least some level of correlation. However, if you think that Trump's coming in and he's totally going to abandon all the nonsense, fairy dust, solar panel, all that electric green energy bullshit, and he's going to go back to fossil fuels, and he might be inflationary, gold's doing fine, but silver and copper are the big conductors. Do you think it's folly to think that he's coming in and he's going to abandon all of it, particularly because we have a lot of blue states that might pick up the slack? What's your thoughts on that?
Well, I mean, full disclosure, gold is my biggest position, and it has been for a long time.
Same.
And it has been for two reasons. One is that, as I mentioned in my endless screed at the top of this conversation, I've been very skeptical about the value of financial assets right now in an environment where all we do is print money and inflate, the economy ever and ever without any kind of real fundamental support underneath it. So I thought that was a house of cards that would eventually crumble. The other second sort of more secular factor for my being long gold was this global shift away from the dollar, looking for alternatives to the dollar as a reserve currency. And I know that gets looked at with real disdain here in the United States. And it's not that I'm not patriotic. I am very patriotic, but I'm also a realist. And I can see, the writing on the wall and the actual moves that the rest of the world is making. In the latest quarter, the dollar share of global forex reserves hit its lowest level in 29 years. I didn't see that picked up in any newspapers anywhere. We've got these BRICS countries that are just accumulating gold like crazy. Gold's not going up because you and I own it, Jim, or, it's going up because China, India, Russia, Kazakhstan, all these economies are buying it. And so we've got this shift in demand from the West to the East. And I think that eventually people here will wake up and see that happening, and gold will then really start to move even higher. But so those are the reasons why I've been long gold here. I like hard assets versus paper assets, and I see it as sort of a play on the diminishing value, the diminishing role of the dollar as a reserve currency. Now, the question is, can a Trump administration arrest that move away from the dollar? And I was honestly, I was puzzled today, and I was emailing with a client about why it is that if everyone thinks the economy is going to be so strong under a Trump administration, they're selling dollars. And then comes the Bloomberg headline, Vance Trump administration, dollar bearish, because, they want a weak dollar to boost up domestic manufacturing. Well, I'm trying to figure out the cross currents there. Well, okay, yeah, you want to support domestic manufacturing, but you also want a strong economy, which should result in a stronger US dollar and a generally higher level of interest rates. So I'm still puzzling over that. I mean, it's so early. We're only 2 days into this new paradigm, so it's still kind of gray to me. I can't, where do you guys come out on that?
Well, here's what I think about the gold. Well, first of all, what I was going to ask you real quickly is, do you think the Bulldog is a sturdy enough breed to guard your gold deposits home, or do you think you need to get a bigger, meaner dog?
This dog is not guarding diddly squat. I mean, if you came in with a piece of bacon, she would roll over on the here's the gold. Here's
I'll give you my thumbprint.
That's why I have a Glock. So the Bulldog isn't protecting me. I'm protecting myself.
So here's you asked what I thought about the gold trade, and I'm curious to see both your opinions on this too. I think the range of 2250 to 2550 is just the range of 1800 to 2000, thrown in the fact that each dollar that the gold is priced in is worth about 65 to 70% of what it was just 2.5 short years ago. I think the number in gold is not even as much reflecting the fundamentals of central banks buying. And for those watching too, Steph mentioned the de-dollarization. I mostly agree with Brent Johnson. However, it is hard to ignore that 20 years ago, 75% of the world's reserves were held in the dollar. Now that number is 59, if I'm correct, 59%. Yep. That is a relatively significant shift. And if they're shifting into gold, then that is a significant tailwind. I don't even think gold is really reflecting that. I think if gold was reflecting both the 65% what the dollar was worth just 3 years ago and central banks, to be trading up about 3,000. Does that seem reasonable to either one of you? Bobby, you first.
Yeah, it does. First of all, I have a mix of a border collie and a pit bull, so she'll actually herd you by removing the bottom half of one of your legs. So it's pretty easy to keep a little bit of physical gold here. I think that's a good thesis. One of the things that I talked about, I've been long gold since November of 2022, and I've traded in and out of it in the futures, but physical I've just held and continued to add to till about 6 months ago, where I kind of rested. But I think that thesis is really good because it explains a move where the new range is set. In other words, it does not have to correct back. It doesn't have to mean revert. If they continue to print money, it has to mean revert higher, even though I'm not using the phrase correctly. So I think that's a great way to look at it, Jim. I think that's a great way to simplify it and point out why it should be where it is.
Steph?
Yeah, no, I agree with all of that. I mean, the one thing that I really 3,000 to me is a layup, and I had thought we would do much beyond that in an environment where we actually saw this asset bubble, as I perceive it, deflating. And then the Fed would do what it always does, which is rush in, re-up QE, take the Fed funds rate back down to 0 or somewhere close to it. And the dollar would go flush and gold would go, to 5,000 in a hurry. I'm not sure that scenario is still out there. I'm not sure it isn't, given what I talked about earlier about sort of the Reagan parallel and the sort of parabolic move that I think we've seen in the markets in reaction to this shift in odds about who's going to win the election. But I still think gold has a place in every portfolio in the environment we're in right now. And clearly, I think we still have an inflation problem on our hand, and the Fed's ability to navigate that in a backdrop of an economy that may actually be reaccelerating is going to be very challenging. And again, I keep coming back to this. if the trade-off is higher rates or a weaker dollar, policymakers will choose the latter all day, every day. And so I think, in our levered economy, having a hedge against the idea that they might actually push that dollar down to kind of inflate away the debts is always a very good thing to have handy.
I wanted to point out that we're live right now. We do take questions and comments, and I want to ask Vigo and our production staff back there to put up the comment by CJ Mendez, which says, the market is pricing in a Trump win, lower taxes, friendly energy policies, less regulations, etc. Markets always front run elections and discount afterwards. I would be very cautious. First quarter 2025 as a Trump win will be stimulative for the economy and may keep the Fed sidelined for longer than most anticipate. My 2 cents anyway. Steph, do you have a comment on that?
Yeah, it sounds like exactly what I just said.
No, I know. And it's true too, CJ. Yeah, I think. Yeah, I agree with you 100% and Steph 100%. Yeah.
Well, CJ's complimenting us on what we said before I read his comment. So
okay.
I don't remember what it was. My second part of the question is that a Harry Potter broom behind you over there over your shoulder?
Oh, this? I don't know. This is the condo I'm renting this summer.
Oh.
Yeah, I guess it is. Well, there's a fireplace.
Yeah,
fireplace.
Yeah.
I'll take you on the tour after, but there's a fireplace here. And if you're hearing snoring in the background, that's because my bulldog is right over here on the floor. So
what's the bulldog's name again?
Wilhelmina.
Wilhelmina, nice.
Love that. Absolutely love that.
You're in the mountains somewhere, right?
I am. Yep, in Colorado.
That's awesome.
That's why I'm in a sweater. Everyone else is probably in tank tops, and I'm like, it's cold. It's 65,
I've been trying to wear a tank top on the show, but Jimmy just absolutely forbids it.
I'm against the rules. Can't have chains, gold chains is fine. Pinky rings are fine. But there's only so much Dago we can have on one show.
So, Steph, let me ask you, I don't know if you can dive into sectors or not, but today was the biggest drop for the semiconductor sector since 2020. Biggest single day drop for the NASDAQ since December of 2022. Is this sector rotation or is this more sort of that threat? I can't imagine that a threat for more sanctions on some of these semiconductor companies by President Biden, who right now looks like he's not going to win, A, and 2, he couldn't do without Congress anyway. Do you think it's one, both, or neither?
I think that is a convenient excuse for selling a sector that I guess one would argue was just extremely overvalued. Mm-hmm. But, I'm not, again, this isn't my bailiwick, but, when I watched the market just get narrower and narrower and narrower, and the entire story was all about tech and AI in particular, that just didn't seem like a sustainable or healthy market at all. So I view what we're seeing now as actually a much healthier dynamic for the markets, where you're seeing things broaden out. The Russell, I had actually done this table just a few days ago that showed, I think in the first half of the year, something like 50% of the stocks in the S&P 500 underperformed the averages. And then in the second quarter, it was something like 65% of them underperformed the averages. And in the first month of the third quarter, the number was even higher. It just kept getting narrower and narrower. And so I think that this is probably just probably an overdue recognition that things had gotten a little too frothy, and maybe it's time for cooler heads to prevail and to look at other opportunities. Because now, if we do actually have a different economic setup, there are other opportunities. We're not just talking about a situation where we're kind of slowing, stagnating, maybe going into recession, and we're all just sitting and waiting for the Fed to save us with some stupid 50 basis point rate cut between now and December, as if that's miraculously going to alter the playing field in some material way.
So, by the way, I was 100% in your camp about the recession. And I was, even as long as a week ago, was beating the drum and saying, we're right, you're wrong, these labor numbers are crap. Yeah. Then that retail sales number kind of smacked me right in the face. And notice probably I did not say Nards because it's a woman and we were a classy show. Smacked me right in the face. I'm trying to bring back Nards from the 70s, and it's just not working at all.
You just said it twice, though, Jim. So I think you brought it back.
Okay.
It's back.
Back to cleaning up. It's back.
It's probably the first 2 times Stephanie's heard that in 30 years.
Exactly. I think that was high school.
Well, that would have been 10 years ago. So go ahead.
The retail sales number was a shot to the nards. Like, what was that about? Is it real strength? And then the revisions, is it doctored? What is it about? Or is it inflation?
Well, the first thing I did, because I'm a nerd, was run to my seasonal adjustment spreadsheet and look at what the seasonal adjustment was for this number. And they greatly reduced the bar that the data had to jump from a seasonal adjustment standpoint relative to prior Junes. So in other words, they made it easier for the number to surprise on the upside because they assumed that there would be a smaller gain from May to June than there actually was. So there's some statistical shenanigans going on, but I think the biggest story is that the entire increase was internet sales. If you took out internet sales, retail sales were nothing. So, and then the final point I would make is that, and we've heard this a million times before, but it bears repeating, these are nominal numbers. They're not adjusted for inflation.
Bingo.
So even if you were to take it at face value at 4/10, what were we, 2/10 on the CPI in the latest number? Or no, we were unched, but year on year, we're now at 3. Right. So you're talking about the 3 and retail sales. I'd have to look at, basically real retail sales have been and continue to be negative on a year-on-year basis. And actually, they've been negative, you won't believe this, but since Biden's last stimulus bill, when he sent out checks long after COVID had ended and he decided, hey, let's just send some more money to people, which was March, I guess, of 2021. So that was when real retail sales hit their peak, and they've gone nowhere since.
Wow.
Yeah, I know, it's staggering. And yet every day you turn on CNBC and they talk about the strong consumer. I'm like, oh my God, these people.
Bobby?
Sorry, I'm just answering something over here. So on the interest rate, on the yield curve side of things, data shows that if a recession does start, we need the yield curve to actually go from negative to its sort of normal shape.
Thank you for not saying steepening. We do say steepening, but it irritates me because technically it's not steepening when it's coming to inversion. But anyway, go.
Yeah. Do you think that's what's happening right now? Because a lot of people thought that the inversion means recession as opposed to an inversion, then a normalization. Jared Dillian pointed out to us last week, and we haven't released that show yet. That'll be on Monday, that we actually got that during COVID, where we had a brief inversion and then a turnaround, and then we got 2 consecutive quarters of negative growth right after that.
Yeah.
So do you think that's what's happening here, or is it not going to follow through this time, regardless of Trump or not? And then, Jim, we have a question from a viewer after that too. So
your question is the yield curve still an accurate signal of a recession?
No, I think his question was more, if it's if it steepens and goes positive, does that mean the recession is going to be here? Right?
Okay. Yeah, well, I didn't
mean to jump in, but I speak Bobby.
No, not at all. I think that, the recession bet now, what I struggle with is I don't know that you can look at metrics like that to decide whether or not the recession is going to happen. Obviously, you always want to look at a variety of measures, not hang your head on any one simple one. And I know that's not what you're suggesting, Bob.
Right.
But I think that, so much of what we're talking about is a function of the expectations about where the economy is going to go and the power of those expectations to create the reality. And we've seen this so many times before. And I'm reminded actually of when Trump was elected the first time. People forget, but in 2015 and 16, we had the worst corporate credit crisis since the global financial crisis. We had massive downgrades, corporate defaults, huge increase in bankruptcies. And it was all brought to a standstill when Trump came in and cut taxes for corporations and massively cut regulation. And it immediately gave these guys a lifeline and some breathing room. So the expectation that those policies are going to be reenacted again can have the power to create that reality, which is why I'm reluctant to say that, yeah, the yield curve could still be telling us that we're going to have the recession because there's that other factor now at play. And Lord knows, I've been exasperated because I've been watching bankruptcies at the fastest rate since the global financial crisis, and junk yields that have doubled from where they were prior, and all this debt coming due, and thinking we're going to have another corporate credit crisis. And it hasn't happened because you get these private lenders out there who say, look, you need to roll 8% junk bonds. Come over to me. I'll make you a deal on those 8% bonds. You don't need to roll those in the, capital markets. We'll do something over here and we'll work out an arrangement. And so much of this debt is actually being refinanced at rates that are lower than reflected on your Bloomberg terminal because of this boom in private credit. And so you're already seeing the expectations create the reality. The expectation that the Fed is going to cut rates is already built in to a lot of the structure. So I guess this is a very convoluted way to answer your yield curve question, but I'm not really sure that I'm going to glean any real important signal from the yield curve. The one thing I would say, and I alluded to it earlier, is that you have seen the 2-year and long-dated Fed funds futures actually move higher in yield in the last couple of days, which I think may be an indication that people are starting to realize if we're going to have stronger growth, we don't need as much Fed stimulus. But the good news for the markets is rather than relying on rates, we're actually going to have earnings to support growth, which, as you joked, and I agree, Jim, is like, really? Who would have thunk? Oh my God.
So we have another comment from a regular viewer, comment question from Tim McLean, who I think you answered the second part of it already. Any thoughts on the 10-year U.S. Treasury going below 4%, and does the yield curve on inverting matter? So I think you already answered. Tim, if she didn't answer the yield curve question, write it differently and put it back in here. But any thoughts on the 10-year going below 4%?
I've been very bullish on the long end of the curve because I thought we were going into recession. Now, I'm still bullish because I think you still have the energy price story and the lower inflation coming. So I think that the long end could come down. But one thing I've noticed and sort of written up a lot to clients as a potential new theme emerging, if you look at these broad economic surprise indices like the Citigroup Surprise Index or the Bloomberg Economic Surprise Index, they've absolutely imploded starting since like late April, early May. I think the Citigroup Surprise Index peaked at like 40 in mid-April, and it's now minus 45, somewhere around that. So it did an 80-point swing in the span of just a couple of months. If you overlay that with the 10-year yield, the 10-year yield's really barely moved in the face of this collapse in the tone of the economic data. That's very atypical. Normally, these two move, if not in lockstep, at least pretty well in tandem. You never see an 80-point drop in the surprise index that isn't met with a substantial decline in 10-year yields. So what I started to puzzle about is maybe we have this emerging new Treasury risk premium as a function of our feckless fiscal finances. But now, if we're going to get into a situation where we're not going to have this egregious spending to support an economy that's being burdened and suffocated by higher taxes, higher inflation, higher interest rates, placing all that burden on fiscal policy, maybe that Treasury risk premium that I thought was starting to emerge won't necessarily have to be there. So again, this is all so new. Or 2 days into this, and I'm still trying to figure out where we're going to go. But I think that, I like the long end just because I think we're going to get some real significant reduction in the key inputs to inflation, namely energy and regulation, and that should be favorable. And maybe you eliminate a little bit of this emerging Treasury risk premium. But that said, I don't know how low 10-year yields go. I mean, again, if we're going to have a reasonably strong economy, why would the 10-year yield really rally all that much?
I know.
Why?
Because here's the counterpoint. Because Trump was one thing that we've seen before. He's not afraid of spending. And I almost put him not on a par with the Biden administration, but he has been a profligate spender. I do not know if he would still be a huge spender if we're in a more higher inflationary regime than we had been in the past. I like to think he wouldn't be. In the event that he is, I think that there has been a few auctions over the last 6 months, although a few of the last ones have been better, where the world has said, yeah, no, I mean, I certainly want your debt. I just don't want it the rate you think you're going to get.
Yeah.
And pulled back their bids. And my concern is that if we start issuing crap tons of treasuries, that's a technical finance term, crap tons
I'm
of treasuries,
familiar with it.
and people back up a little bit, I do think that the curve is going to steepen and we could conceivably see rates at 10%. I'm not asking you to agree with me because I know based on what you said that you don't, but that is at least a reasonable take and it belongs on the whiteboard, correct?
No, I absolutely agree with you. I mean, this is why I think I came back to gold, really, because I felt like if it was going to be the status quo with another Democratic administration that didn't change any of these policies, and then we would see endless, mounting deficits, and we would have to finance all those either at higher rates or have the Federal Reserve
come in and buy it all.
Come in and buy them, which is what I thought they would do, is say, there's no way we can maintain this as it is already. We're financing $2 trillion deficits with T-bills because Janet Yellen's figured out, like, we can't finance this with 10-year paper. This is not a sustainable gig. And we're already doing that. So what happens when these deficits are 3 trillion, 4 trillion? It's crazy. So I totally agree with that. The one question I would have, though, about Trump, and, I'm literally asking this. It's not meant to be a gotcha question, but the spending that he did, wasn't that because of COVID? Or
most of it. Not all of it, though. Like before that, I complained prior to COVID that he still spent quite a bit, even when the economy was supposed to be in a good place. Yes, overwhelmingly the lion's share was to avoid any sort of deflationary collapse when March of 2020 happened. So when these people on the left say, well, your guy, which by the way, he's not freaking my guy, I just hate the other guy. Like, oh, he spent as much. No, he didn't spend. It was appropriate to be spending money to counterbalance these asinine lockup of global supply chains that was happening. I mean, there's no question that Trump, to me, starts with a clean slate in some ways about what I believe his proclivities are. Bobby?
There is a demarcation line between Trump and Biden in terms of spending. And it's not as dramatic as some people might think, but versus history, it's dramatic. President Trump, as president, never spent more than 4.6% as a percentage of GDP in his deficits, right? Fiscal deficit. He never reached, his highest was 4.6%. COVID, 14.7% deficit as a percentage of GDP. Let's give Biden 2021 as COVID spending. Steph, you already mentioned it's probably unnecessary to send out these checks, but they send them anyway. Yeah. Negative 12.1% as a percentage of GDP. But then Biden has never spent less than 5.4% in terms of deficit spending. So he was a full percent, almost a full percent worse than Trump with no real reason to do it. Plus he had the burden of inflation and he was spending more than Trump. So sort of like a double-edged sword to me. And the OMB has now projected any less than 5.1% for Biden going out through 2026 if he were to win. So both spenders, Biden worse than Trump, if you give them both those sort of big numbers as COVID spending.
Amen. And by the way, when people compare the two, it is asinine to compare spending when you're just absolutely freaked out about deflation compared to hitting the gas pedal after 2021, when CPI was already printing over 5%, the housing market was inarguably on fire. And to go, you know what? I'm worried that this may be transitory. Let's lock this sucker in. And they buy a shit ton more bonds and keep rates low and spend like drunken sailors.
Yeah, even the MMT guys were like, what are we doing right now?
Yeah, that was crazy. Steph, I have another question about the impending recession, which I believe to be coming. If you look at a chart of small business optimism and go back, let's say 15 years with it, and I release this every couple of weeks and I mark the times where it is obvious, clear that there's a new administration coming in, which we believe will be more friendly, our optimism rises. I believe that is probably when the next read of it comes out after the events over the weekend, that small business optimism will rise. But the question is this, if the era of good feelings comes about with small business because we're pricing in a Donald Trump presidency, could it be powerful enough to take away the recession and actually maybe give us the soft landing?
Well, that's what I've been puzzling with. The NFIB has the uncertainty index as one of the components. I don't know if you've charted that on one of your things, but that one's really amazing because not this last reading, but the one before it, it was so bleak. I think it hit the worst level since the global financial crisis or something. So they were really at their wits' end. And it improved ever so modestly in the latest month. But I think that's clearly they're in the doldrums, and they're the ones that are really feeling the squeeze from higher interest rates. Again, they can't borrow in the capital markets, so they're really suffering. They've locked in higher wages for their employees, and they're paying massively higher costs, input costs. So they're getting hit on all sides. There was, I don't know if you look at the Duke University CFO survey, it's a quarterly survey. It came out just a week and a half ago, 2 weeks ago. And it actually found a huge number of the CFOs literally said they were holding back on CapEx because of uncertainty about what was going to happen in the election. And they were going to wait to see what happened. So I think the events of the last weekend, to the extent that they have almost solidified the Trump victory, would have the potential to get these guys to say, look, if we don't start now, we're going to be behind all of our peers. So we got to get out there. We got to have the first mover advantage here. So I do think I'm very aware of the prospect that you could have the expectations create the reality. And I'll confess, when Trump was elected in 2015-16, I was talking earlier about how we were in the middle of that corporate credit bust. I was forecasting a recession, and I was like, this is the world's on fire. The corporate markets are melting down.
I was too.
Time, before the economy goes into recession because they're going to be laying off people and blah, blah, blah. And that thing did a freaking U-turn. I mean, it's like I was not prepared for what happened, and phooey on me, because I kept thinking, well, the recession's coming. It's going to take a long time for these policies to actually impact. Well, hello, the expectations created the reality, and they did so in short order. And now we're working in a situation where people have seen the history. They know what's going to happen because they lived through it in 2016 to 2020. So it's not a mystery. They know what the playing field will look like if he wins. So they should be ready to roll. This is why I'm very gun shy now on the recession call. I mean, but on the other hand, I don't want to be, too Pollyannish about it. I mean, I think that we have a lot of real problems, and it is still 6 months before he actually, if he wins, gets into a position where he can do anything about them. And there's a lot that can happen between now and then. And heck, it's not even guaranteed that he wins, because we've seen that the other side will stop at pretty much nothing to make sure that they maintain power. I mean, I don't want to get political, but I think, they see that the tables have turned pretty markedly. So they're probably scrambling, and who knows, you always had that October surprise. We'll see what happens. This October, we have another potential surprise, and that is that BRICS Plus summit in Russia. So who knows? But getting back to the election here, I think there's still a lot of time for mayhem between now and January. So all the economic data are telling me that we're headed to recession, but I'm mindful that the expectations can create a new reality. So what I'll be watching is the CapEx indicators, that NFIB, the CMO surveys, capital goods orders, and employment, because they're going to need to hire back the people that they were laying off if they really believe things are going to turn.
So we don't have Steph forever. If I had my way, we would have Steph forever. But so I want to throw them both up, Jimmy, if we could. Another one is from Tim. Tim's asking, will the U.S. see an ROI above zero for the IRA, which is the so ridiculously Inflation Reduction Act and the CHIPS Act? Steph, go ahead. And Jim, if you have an opinion, jump into.
I always have an opinion on the government.
Yeah, no. I don't think you see an ROI above zero on any government policy.
That's perfect. Jimmy?
Ditto. Right, is all I got for that.
Perfect.
Yeah, I think the only question is how disastrous.
How negative is it? Yeah.
So okay.
All right,
Thank you.
CJ's got a longer one.
Okay.
That'll be the last question for those of you.
CJ's smart. I like it. I like it.
For those of you queuing up your questions. Vigo, you got that one ready? I have always had a hard time buying into recession forecasts while labor markets remain strong. If Americans are working, they're spending. It's very difficult to push the U.S. economy into recession without some distortions in the labor market. First, what is your take on jobs into year end and next year? And as you both know, we're approaching the SOM rule, so that almost takes care of it.
Can I get a quick answer in before you, Steph?
Yep.
I think the jobs have been crap that they've been trying to tell us have been great. I've been their second and third side hustles. Full-time jobs are completely in the toilet. I think the labor data that we see is the greatest story ever told.
You just took all of my points. I was going to say, first off, the numbers are complete BS. There's so many indicators there. There's the gap between the household survey and the payroll survey. Whenever it's been this wide, you've been in a recession. Payroll survey always gets it wrong. Household survey always gets it right. The unemployment rate, the SOM rule has been triggered. And the SOM rule, for those who are unfamiliar, is when the unemployment rate moves up by 0.5 percentage point on a 3-month moving average basis from its low, you are always in a recession. We did do that. And generally, once you move up 0.5 percentage point, the unemployment rate goes up another 2.8 percentage points before it's all over. That's the average excluding COVID. If you include COVID, you're north of 3 percentage points. So the long story short is we should be looking at a 7% unemployment rate in short order, because I don't know if you're familiar with the chart of the unemployment rate, but it's like this. You know, you don't just go up 0.5 percentage point and then kind of roll over and whatever. You go straight to the moon. It looks like a junk spread chart, basically. Yeah. And then the other thing, the point you made, Jim, it's not an accident that multiple job holders are at a record high. People just can't make ends meet with one job. I'm here at a sort of ski resort town in Colorado, and everybody working in a restaurant has 2 other jobs. Mm-hmm. Everybody around here is working 2 or 3 jobs. The guy who's the night auditor at the condominium complex I'm staying at then goes and works at Safeway when he gets off the night shift here until 11 in the morning, goes home to sleep for a few hours and comes back here. And that's just what people are doing to make ends meet. So yeah, the employment numbers are BS.
Right. We're not in Kansas anymore. Things are different, and we're not going to live the same way, in my opinion, that we did in the 90s through 2015. I would love to keep you forever, like Bobby said. By the way, how do I get a rule named after me? You got the Taylor rule, the SOM rule, the Laffer curve. Do you have to fill out forms or anything? Get back to me on that. We'll talk about it at a future date.
Heck, if I knew, there would be Wilhelmina rules all over the place.
There is a Pomboy rule. The Pomboy rule is shut up and let Steph talk.
Exactly, which I thought we did pretty good.
I think we did.
Okay, we're signing off. This has been the Trader's Edge. Thank you guys so much for joining us. By the way, none of this works without the audience we have and the feedback from you guys, the DMs, the retweeting. We are so appreciative of you guys. Remember Bobby and I's mission? We both spent a lot of time in what we hate to call mainstream media, but that's the best way to describe it. And we felt a lot of pressure for opinions from producers, from sponsors. Here we give our honest opinons. They may be bullshit, but at least they're honest. Thank you for joining us, Steph. You can find her on Twitter at
macromavens.com and on Twitter at @spomboy.
That's fantastic. Thank you so much for being here. Thank you guys.
Thank you, Steph.
Guys. So much fun.
Vigo, remember that to end the show, he's got to press a button or something. We can't just sit here looking stupid forever.
Just imagine him falling off his chair or something. Right?
Now he's scrambling to the computer.
I can look stupid forever. That's how I always look.
Yeah. By the way, don't cut this part out for sure.
Well, I mean, we're still live right now. I'm watching the YouTube feed over here. We're still live.
Really?
So
All right, Wilhelmina, it's your chance. You want to have a debut over
Well,
here?
let me see her. Is she there?
Come here.
Oh, look at her.
Oh my God, you can't see her, can you?
It's like-
Oh,
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.